Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Today is episode 33, so thanks everybody for joining us for the meeting with Alan. So we'll get him to introduce himself in a minute. So our goal is to keep this group small, so we can actually talk about multifamily and actually learn about Alan's experience, the good, the bad, and the ugly.
Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice.
So in terms of introduction, again, thanks everyone for joining. My name is Marcelo Cazini. I'm here in Houston, Texas. My background is in IT and software development. I'm a local CCIM member here in Houston with all the CCIM designation training. And I'm a multifamily investor, and I own and operate my own commercial real estate.
Yeah, you go in Sands.
And prior to multifamily, I was involved with single family fix and flips. So thanks again, everybody, for joining us.
Hi, everybody. This is Claudia Rubio. I was born in Colombia, South America, but we've been living here in Houston for 8 years already. I have an architecture degree and I have a National Apartment Association IROP certification, which stands for Independent Rental Owner Professional. And we have been doing multifamily since 2018 with Martin. Martin, you want to go ahead?
Sure.
Tell the story.
So I'm an IT security consultant. I've been doing this for around 25, 26 years. My background is mostly on business management. I've had my own consulting firm and several other businesses before. As Claudia mentioned, we started doing multifamily in 2018, and we have around 38 million in assets under management, around 500 units that we have syndicated here in Houston.
All right, thanks, Martin, Claudia. All right, Alan, do you want to introduce yourself?
Sure, can you hear me okay?
Yep.
All right, so howdy everybody. Thanks for spending a little time this evening. So Alan Stewart, just as this year I became a best-selling author, which was a pretty cool process outside of multifamily investing. I've been full-time doing this for just about 3 years now, but almost a decade in multifamily, and then I did some single family stuff before that. I've been involved in 16 assets, 7 have gone full life cycle, 4 of those where I was on GP. Most of those are in Texas, actually most in DFW, a couple in Amarillo, and then some in Athens, Georgia. And before that, I went to A&M, I studied engineering, and then right out of school I went into management consulting. At the time was Anderson Consulting, became Accenture, and so I did a lot of strategy consulting, business and system integrations consulting for Fortune 500 clients that were in the manufacturing, retail, telecommunications, energy, and I'm sure I'm living out some. So, and then on the personal side, so I've been married for quite a while now, and we have 2 adult children. One's 25, turning 26 in about a week and a half. So he actually also went to A&M, and he's off the payroll and on his own. He's an engineer at Texas Instruments, so it's always a good metric. Wow. And we have a daughter that's 21 that's studying interior design at UNT up in Denton. So that's me.
Okay. So I'm gonna get started with some questions, Alan. Okay. Can I go ahead? Yeah.
Yep.
So we would like to know, Alan, what is it that attracted to you about multifamily? What's your why?
Sure. So actually, it's a longer story, and I'll try to give the short version. But in 2001, so I was a few years into consulting, and I went to a conference in Dallas where Robert Kiyosaki and Donald Trump were speaking, and that's when I first got introduced to Rich Dad Poor Dad and the whole idea about investing in assets as opposed to trading time for money. So that was like the light bulb that went off for financial education, and so I started on this journey of searching, well, how could I do it? And it was really an 11-year journey of searching, how do I get started? And, you know, I dabbled in some single family wholesaling and things like that. And I kept searching and searching, you know, while I'm, you know, doing my complex corporate job. And ultimately, you know, I got hooked up with, you know, a multifamily mentor. And in 2012, you know, and it was local, and it was real. And, you know, why did it click for me? So, you know, I was a busy professional, and so time was at a premium, and I was trying to find a way to, you know, create, you know, retirement for myself, you know, better time freedom over time, you know, get out of the rat race, kind of all of those things. And I saw multifamily is much different than single family, in that how it was valued as a commercial asset, how the loans were done, how you could partner with people and pool money to buy larger assets, and then be able to afford, you know, a professional third-party management company to run it. Going back to, I needed the leverage of time. And so it allowed me to, you know, really leverage, you know, other people's time and experience, both as a GP of my service providers, but then also I've done several LP investments and leveraging the time and effort of the GP teams in those deals. And so that's what attracted to me. And, you know, now I really like the industry. You know, it's a feel good industry. And, you know, it's afforded for me to, you know, now do this full time, which, you know, I used to, you know, basically be a partner with a consulting firm. And so I ran the greater Texas region. And so I had a pretty full calendar and a lot of traveling, and, you know, being able to take control of my calendar was pretty amazing. So, you know, that's kind of it. And then, like, looking forward, you know, I got my parents involved, my brother, and, you know, my parents were small business owners, and they had a small automotive shop, and they, you know, I didn't know when they were going to retire, and I was able to eventually help them into the idea of investing in multifamily, and got in some investments, and a couple of those went life cycle, and they got in some more, and they were able to, you know, sell their small business and retire 2 years ago. So, you know, that's a feel good side of the business as well. And, you know, that's kind of one of the reasons why, you know, continue syndicating, is to provide, you know, those kind of opportunities just like that I was looking for. So I know it's kind of a long answer, but
No, that's good. That's good. That's awesome. So when you were starting, you said you found this mentoring group. Was that your only source of information to get educated on multifamily, or did you use anything else, like, I don't know, podcasts, meetups, anything like that?
oh, that's a great question. So it's kind of funny, you know, because we're talking 2012. So it was really, you know, 2011, 2012. It's really not that long ago, but a lot has changed. There were no podcasts that I was aware of. I guess there was maybe bigger pockets and you know, a couple of big ones that have been around a long time, but it was not a thing. You know, the whole idea of, you know, these meetups and things that are happening all over the place now, that did not occur. So finding a group of people that was getting together and interested in the same thing, it was the primary way that I learned, you know, outside of, you know, general things like, you know, books like Rich Dad Poor Dad, and, you know, some other things that are, you know, business related, you know, I leverage that, but specifically to multifamily, you know, that's how I got started. Today, there's lots of opportunities. And, I would probably have gotten started a lot faster had I been afforded those opportunities at the time.
Right. Okay. So when you felt ready, you had enough information to start looking for that first deal. What was your basic strategy? Like, what market did you focus on? What kind of type of property? Those kind of things.
Sure. So when we first got started, there was 4 of us that said, "Hey, we want to go buy a smaller multifamily property, and just be the 4 of us." That was the original idea. And so, we started looking, and just like when you get started, you don't know the brokers and they don't know you, and you're figuring everything out. And so, we had some fits and starts, and ultimately, I actually did 2 passive investments first while we were searching, because I kind of want to get started, and that was really a great way to start because there was a whole new level of learning that occurred through that, and meeting other people. But then right after that, one of those 3 other guys, so he and I found a deal on LoopNet of all places, and it was 38 unit E-class property in South Irving, which is a suburb of Dallas Fort Worth, and it was in sorry shape. But nobody was looking at it, and it was a kind of a lengthy discussion with the seller, but ultimately we ended up buying that deal, and Brad had helped us actually as the buyer broker in that deal.
Did you end up raising money for it?
So in that one, it was just the 2 of us.
Just the 2 of you.
Yeah. So, we raised money from each other.
And how many units was it?
That one was 38.
Okay.
Yeah.
Okay.
Okay. So how long do you think it took you from when you were ready until you closed to get that deal?
From 0 to 1.
Oh, okay. So from when I started, let me think. Specifically, I started my specific multifamily education in March, and then it was January the following year. So I guess that's 10 months.
Okay.
Yeah.
That's pretty typical.
Yeah.
Okay.
So,
What would you say were the biggest challenges you had at that stage to overcome to get that first deal?
I mean, it was just having to build a team. We didn't have a track record with the brokerage. We didn't, it was the first time we were working with the attorneys, the first time you're working with the title company, the first time you're working with the due diligence providers, first time with property management companies. So leveraging other people's experience and recommendations. So that took a good bit of time. And, we of course made some mistakes along the way with that. But the hardest thing was really finding the deal.
Mm-hmm.
And, now, I mean, as everybody knows, as your relationships get better with brokers, they control most of the deals. So the way that we found this one is, I would say is definitely a one-off, but, we were doing everything we could, and that just so happened to be the first one that came across our desk.
Okay.
So a lot of people on our group, they're coming from the perspective of going to 0 to 1, getting their first deal, and in a lot of cases they're looking to syndicate their first deal. So in our first 38 unit, you bought it as a joint venture. Tell us, how did you make this switch to maybe start syndicating, and how was your experience in syndicating your first deal? How many co-sponsors did you get, and how many units?
So technically the first one was a syndication. It wasn't structured as a joint venture, but the second one, which was also syndication, had others. So there was 2 of us as sponsors, and basically it was another smaller deal. It was a 14-unit deal in the suburb of DFW. Different kind of deal. That one was all townhomes and a nicer property. It wasn't really a value add. And that one was found through a broker. So that was, I would describe that as a more typical transaction, just a smaller one.
And you raised money for it from
Yes.
outside of the GP group?
Yeah.
And how was your experience raising money for the first time?
I was fine. I mean, because, at this point, I guess we were a year and a half into it, and I had invested in 2 deals, and we had done the 1 GP, and I'd met a lot of people over the year and a half.
Mhm.
And so, we went to raise it. We kind of already developed those relationships with folks. And so when we put it out there, it was a pretty simple process.
How big was that raise?
Oh man, you're gonna make me remember. That was a while ago. I was smaller deal, probably, I don't know, maybe 350, 400,000, something like that.
Wow, that's a small raise compared to what we're doing nowadays, right?
Yeah. Yeah, things have scaled up.
Yeah.
And what would be, again, for someone who starting now and they're looking to do their first syndication, buy their first apartment, given where we are, the state of the market with the intensity of the competition, what would be your best advice for somebody who wants to start now? I mean, in terms of what they need to do, in terms of maybe number of units that they should be looking for, what would you recommend for a first-time syndicator?
Sure. So, I would just do the same thing that I did, which was, get educated and find a mentor. I was a consulting for 20 years. So, seeking out professional advice is like a normal thing for me. And I view that as a way to shorten my learning curve and reduce my risk. And so, some people might look at it as a cost, but I look at it as an investment in going faster and reducing my risk. So I would definitely do that because, as you go along, there's always going to be things that you don't know. And, you want to ask a question of somebody that's, hopefully been there and done that, which could be, somebody that you're partnered up with if they have, been there and done that. But definitely, we had lots of questions when we started and we needed to ask somebody. And so that somebody was our mentor. And in terms of size these days, so, I kind of put it in 2 categories. Well, we talk about geography first. So I'm a big fan of investing in your backyard if your backyard is a good place to invest. So like, for example, I live in Texas and some of you live in Texas. So Texas is a good place to be. And so if your backyard happens to be that, then awesome. Or your backyard happens to be Atlanta, Georgia, awesome. If your backyard happens to be San Francisco, California, I don't know if I would recommend that. Maybe you need to look at someplace else. But not to pick on San Francisco, but I'm personally a big fan of really understanding the market. And if that market's in your backyard, you're probably going to understand that the best of any. But anyone that you go into, you need to, if it's a new market, you need to go spend some time there and get to know what's going on. Because as we all know, like, we instinctively know what are good areas and bad areas, where we live. But, you go to a different city and what might appear to be good, a local might have some insights that could really be helpful, right? So that's what I'd say in terms of geography. And then in terms of size, I really, and I'm not like a a multifamily only guy. I mean, that's what I do. But when I get asked the question, as people say like, oh, single family, multifamily, small multifamily, big multifamily. Well, it all works, right? I've done all of that. And these small multifamily deals that I did, and we did fantastic in them. So it's not that they're not good deals compared to big deals, and also done big deals that have done great. But it's more about like, think about what it is you like to do. So for example, if you're somebody that really likes to control everything, right? And really wants to be hands-on and wants to be in the day-to-day, then, having a portfolio of single family or a small multifamily where you're okay with, doing some of the management and the hands-on, that can work out really well. Conversely, if you don't have that kind of time, or you don't want to do that kind of work, you want to leverage other people's kind of time, like I was talking about, then yeah, I would say, probably, 50 to 60 units is probably the lower end of making third-party property management work. I mean, if you could slide up to 80 to 100 units, it'd be economies of scale a little bit better. And so that's kind of what I would say is that all works. It's just the bigger deals, it's a little bit more about focusing on investor relations and capital raising, more so than if it's a smaller deal where you have to be more hands-on. And that's why to me, I know what's good for me, but I always try to think about what you like to do and what you don't like to do, and just be honest with yourself about that. And then, in terms of type of deal, so, the ones that I started were pretty hairy. I've done several like that, and it was a full recourse bank loan, where I had to sign, joint and several liable. And, I don't really recommend that unless you're up for a challenge and you got a bottle of Tums at your bedside, because things can get a little hairy. Not that it's bad, it's just true. So I would probably recommend for most people, because most people are busy, all that being said that I just said, most people are busy. Most people are looking to leverage once they're interested in multifamily. So I would say, 60 units or above is probably good. That way you can have professional third-party property management. That way you don't have to figure out all of the day-to-day things. You don't have to do the hiring and the firing. Those type of things. So you can leverage that experience, again, to reduce your risk. And then in terms of type of deal, I mean, having a value add component is okay, but just because a property is, completely torn apart doesn't mean it's necessarily a better deal than, say, a property that is maybe doesn't need too much done to it, but it's more on the management side. And if you can, just a little bit cleaner, there's a few things to do here and there, but not too crazy, not too heavy of a lift. I'd probably recommend that first, because there's just less factors, less risk, and just get going and have a success. And then, you can, as you learn, if you want to take on a little bit more challenges, you could always do that later.
Mm-hmm.
Yeah, that makes sense. Now, what's your approach for underwriting? I know we get a lot of questions from people in terms of how do you typically, what's your process for underwriting a deal? Do you have some key characteristics that you look at it and then you say, okay, yes, I'm going to move forward? Because a lot of times you're starting getting a lot of properties from the brokers. So walk us through your underwriting process, and maybe what are you looking in terms of opportunities for increasing revenue, for decreasing expenses, and that will get you to be excited about a deal?
Sure. So first, I get really clear on what markets I'm interested in, and then I break that down into which submarkets are acceptable submarkets, and then ones that if it comes across is just a no. So I basically have my list of things. If it's in that those geographic areas first, okay, fine. And then I look at, well, what kind of deal is it? So, you know, I've been looking for a little bit newer, nicer deals. And so, but aside for that, it's just what type of deal you're looking for. So if you're looking for, an 80s, property in the suburbs of Houston, for example, and it's not like a deep value add, and it's in a, decent area, put that together. So like for me, going back to how I think about it. So then the type of property that it is, the size range that it is. So, for example, from a syndication standpoint, it's usually, well, how much of a loan size will it take to buy the property? And so when you look at your team and the financial balance sheet of everybody that you're planning on going after, how large of a property can you go after? And as well as then looking about, well, what kind of loan do you think you can get? Ballpark, which then tells you, generally speaking, how much capital it would probably require. And so if it's in those ranges, then it's something to take a look at. And if it's, a lot of people, I think, maybe are not necessarily honest about like what's their actual box that they can go after or want to go after realistically. But the more that you can refine that, the simpler it'll be of someone that comes across your desk like, oh no, I'm not looking at that, not looking at that. Oh, that one, yeah, I want to take a look at that. And so if I want to go take a look at it, usually these days I'll do a quick little, if I'm not familiar with the neighborhood, I'll do a quick little drive-by, like in Google Maps, to kind of see what's around it, and it's again about the neighborhood. If I'm not familiar with that specific spot, if that looks okay, and you see that maybe there's a school around or some nice things, and it's not by a big industrial area or anything that would just turn me off. Because again, I'm just trying to figure out the things that are just giving me that quick no. There's no reason to look any further. And so if that looks okay, then this goes back to, I like investing in my own backyard for the most part. So, I'll go out and drive the property in the area and just see if it's an area that, makes sense. I look and see what's being built around it. How does the landscaping and just the overall look and feel of the neighborhood, does it feel like an area that I'd want to buy in? What else is being built around there? Can I tell if there's anything, any new competition that's coming up, or there's some new retail or something like that's coming up, or new development that it's just getting started and it's going to be really, cool draw for the area. So just get an understanding of the area, so I can understand high level in my head what could the potential be for the property on a longer term basis. And then if that all makes sense, then of course I want to get a hold of at least the offering memorandum, and ideally some financials to do a quick version of that and see if it, meets the initial high level. Okay, I think it could pencil out high level. And if so, then, I'll schedule a tour and go on a tour. And then, when I'm serious about a deal is I don't go on tours just to go on tours. I'll typically bring, the partners with me that I'm planning on working with. I may bring my lender, if available, property management company representative, if available. I mean, I prefer to have all these people there, especially if I'm really serious about a deal, because then we can all put our eyes on it one time and, kind of make a decision, that makes sense or not. And brokers, it's not that you can't go visit properties multiple times, you can, it's just, but they appreciate it when you're respectful of their time as well. So we go through all that, and if I haven't said no along the way, then we do full underwriting, and if that makes sense, of course we're getting then a pro forma from the management company, and we kind of compare what we put together and what they put together, and see what we think is achievable. On the taxes, we use the same tax consultant usually for every deal, and so we'll reach out to them and get their opinion of where they think taxes are going to be for this year and next few years, and then we'll usually get an indication on insurance. And so those are the high level things that we do look at, and if that all makes sense, then we start dialing it in further, and trying to see what other rocks we can overturn, for example. And I guess this goes back to the tour. It's like when you're looking at the physical side of the property, it's like, well, how do the amenities look, and what could you maybe do with them? One of the big things has been dog parks, and do they have a wash station? Do you have private backyards? Is there space to do that kind of stuff? So just getting that sense of what might be possible, because then going back to after you thought, okay, well, it can make sense, then we start dialing in, okay, what are these value added components, so that we can go for where the current rents are to what the sub market could bear, and what does it kind of take to get there. And then of course we get further into that, sometimes we have our general contractor look at a couple things if it's going to be some really big ticket items, especially when we were doing big value add stuff. Like if I knew something was going to require some engineering, or something really big, I'd want to get at least a ballpark estimate on those really big ticket items. But usually that was kind of enough to decide whether or not we want to put in an offer, and kind of continue down the process.
Mm-hmm. That was a great explanation of how the process is, because I think that's the process that we all follow mostly, and it's good for all the folks here that want to do their first syndication to just review that process from when you get your property within your criteria. How do you get to the point where you're gonna be ready to put an offer or not? That was great. So with your experience today, is there anything that you will have done different on those couple first deals you did?
Sure. I would have held on to some of them longer, that's for sure. Like that one I first told you about, just to give you a story of, we all know what the market's done, but just to put numbers to it, we owned that deal, and for 2.5 years, close to close, like to the day. And, we made like 160 something percent on it. So, it was, more than 2.5 times our money, right? So we were very happy with that. However, we ended up selling that to some other people we knew, and it went from a recourse loan to a non-recourse loan. So like their basis in the property in terms of their capital was about the same as ours. And so we knew it was going to be a good deal for them. And then, because we bought it for like 13 a door.
What?
Yeah. It's different times. And we sold it for 38 a door.
Wow.
And we thought that who would ever pay that much for it, right? And they went around and sold it, I think 3.5 years, and sold it for like, I want to say like 60, 65 a door or something like that.
Wow.
So they actually made a lot more money than we did with much less work. And then the property, I know who bought the property after that, and I think they were thinking about selling it. It's gonna, it's like up to, I don't know, something crazy like 90 or 100 a door or something like that.
Oh, wow.
I mean, not that it all would have been easy along the time, but just to give an example of like a different strategy that we did on one of our investments. We've refinanced that property twice. So we've held it a little, like 8.5 years, I think now. And we refinanced it twice. So the first was a supplemental to our Fannie Mae loan, and the second was a full refinance. But in both times, we pulled some capital out. So sitting here today, we have double our capital out of the deal. Plus, we have that much equity in the deal, and it still cash flows really well. And it's boring. There's nothing to do. It's fantastic. So point being is I would have done a little bit more of that strategy, because also those are not taxable events. And it's kind of like, once you've got things dialed in, you know what you know, and you know what you have, as opposed to when you're buying something new, usually you got to, figure out where the warts are and, sort those things out over the first couple of years. So that's one thing I would definitely do different. The other thing I would do is, I've made a few management company changes over time, and I guess we've done it, so it's not that we didn't do it, but sometimes when your gut's telling you that you need to make a change, you need to go ahead and execute that change, as opposed to giving too many chances. So
Hire slow, fire quickly.
yep.
Yeah. So when you're looking at properties, are there any deal killers that will make you not pursue the deal?
Yeah. Well, I mean, at the very start, talking about like submarket, like I will not buy in high crime areas.
Mm-hmm.
So if it's a high crime area, I'm out. I don't do that. And I also do not prefer where median income is, below 35,000 at the very, very lowest. I mean, even that's, 40s, kind of, it's just my experience has been, it causes more challenges.
Right.
So I just choose to avoid that. But when you're doing a property, especially an older property, if you have like a dry cleaner next door to it, or a gas station next door to it, it's been there a long time. If you can get a copy of a previous environmental report and it shows that everything's okay, then great. But if you have some reason to think that it's gonna have something, and if you thought you had to do some kind of environmental remediation, in general, I would be out on that. Never say never, but that stuff is crazy expensive, and I'd rather just do something else.
Mm-hmm. Mm-hmm. And physically wise, like in the building or the structure of the building, are there any things you will stay away from?
So I had a deal we were working on where there was a fire. I have a couple deals actually where there's been a fire, and it's not necessarily a bad thing. Or let's say there was a hailstorm, and maybe these things happen during escrow, so it's not really anybody's fault, but it happens. And as long as everybody is trying to be reasonable and figuring out a way to make the financials work, make everybody whole, whether that be assignment of the insurance proceeds and the loss of rents coverage, post-closing, or adjusting the pricing accordingly, but doing something that makes good business sense. Like, I'm okay with that.
Mm-hmm.
But we we actually recently walked from a deal where there was a fire and we were talking about moving our insurance proceeds, but they didn't want to talk about the loss of rents coverage. And I said, oh, the calculation's too complicated, which I completely disagree with. And it was a big fire, so it's a big number. And, you know, they were just being really squirrely about it. So we decided to, you know, pass. Because again, they just weren't being reasonable with, you know, how that loss was occurring.
On the typical things that some people say to new syndicators to avoid, like boilers, chillers, flat roofs, anything like that. Do you have any particulars that you would recommend first time syndicators to try to avoid?
So, I mean, I'm not anti-boiler or chiller because I mean, there's a lot out there. You know, the first deal we invested in, it had a chiller and a boiler system in South Irving, and that third one I was talking to you about, that also had a chiller and a boiler on part of the property. So, you know, if they're in decent shape, and you have a professional that's telling you they're in decent shape, then that doesn't necessarily scare me off. Now, do I prefer individual AC and individual hot water heaters? Yes. And today I'm not really looking at chiller properties, but you know, you can look at the chiller, you can see if the chiller is in, you know, decent shape, and you know, if you have reason to believe that you don't have too many plumbing problems with, you know, all of the, you know, boiler and chiller pipes in the ground, then it's okay. But if you had the option of getting something with individual AC, individual hot water heater, that's simpler, right? I just, you know, sometimes there's just great deals, and it's like, you know, for example, you know, really, you know, large high rises, you know, big commercial buildings, you know, they all have chillers, right? So it's not like, you know, chillers are not a good way of, you know, cooling a building. It's more about the pipes in the ground, and is it in an area where the soil shifts a lot. So I guess that's the way I would say it. If it has a chiller and a boiler and it's an area that's prone to foundation movement, soil movement, foundation issues, I would not do that. I would not do that. But if it's in a solid area where there's no problems with that, and you've got, you know, a reputable inspector that says everything's okay, I mean, that'd be fine.
Okay. Do you have a tool, system, book, podcast that you are using now that you have more experience to keep updated on the latest in multifamily that you would recommend?
Yeah, I mean, speaking of podcasts, so, you know, when, you know, my friends Paul Peeble and Michael Becker created the Old Capital podcast, I guess it was back in 2015. You know, so I've been kind of listening to that since then. I've always liked that one because it's, you know, primarily multifamily, and, you know, they're interviewing owners, they're interviewing service providers, you know, people that are actually doing stuff and talking about real deals. And so it's more of a case study format. So I always found that to be pretty interesting, and continue to find. I also read the Pensford letter from JP Conklin. And so this is more about, you know, interest rates and things like that. So I subscribe to that. You know, it's a free letter that comes out every week. And also JP, you know, he kind of has he's kind of a creative writer. So some of his stuff, you know, is a little bit engaging, some of his copywriting and things. From time to time, I've listened to some of the real estate guys podcast, depending upon who's being interviewed there. There have been some good people, and I'm always wanting to, you know, learn new things. And it's a different crowd than like usually I see on the Old Capital podcast. So if there's somebody, you know, I haven't heard from, you know, maybe I'll listen to that. Let me think. What am I leaving out? Oh, well, also going back to so on the finance side, not a podcast, but it's a YouTube channel. So James Ng has a YouTube channel, and it's really about multifamily financing. And I think he does a really good job of giving some 101, 201, 301 on financing. And I really like the way he does it in smaller, focused, bite size. It's could be 5 minutes or 10 minutes or 15 minutes, but I'm a big fan of that short period of time, because it's kind of like with some podcasts, they get to be 40 minutes, 60 minutes or longer. I have a tendency of, can we get to the meat of the conversation here? I think James does a good job about that. But those are a couple of things that I definitely look at regularly.
Okay, awesome. And then regarding market analysis, do you have any platform or tool that you prefer that you can recommend to others?
Yeah, we usually get a Yardi Matrix report and or a CoStar report, when we're, really serious about underwriting. So those are the main services. We have used ALN from time to time, but more recently it's been Yardi Matrix and CoStar. And then we also leverage the broker community, for example, with sales comps and things, because some of that stuff is not in CoStar, but with the big brokerage houses, they kind of have their own database. So when we're getting to that level, we'll ask them for some of their insights there as well.
I think we have time for a couple more questions. What is the worst thing that happened to you in one of your deals?
The worst thing that happened to me? I mean, I haven't had anything that was just terrible. I mean, we've had challenges. I mean, let's see.
And if you wanted to scare someone thinking about syndicating, is there anything that would scare them, like the fire or anything like that you mentioned?
Yeah, no, actually, I just thought of what it is. No, the fire is not it. I mean, fires and, we had the snowmageddon and, broken pipes and all that stuff. But I mean, all that stuff is pretty easily fixable. I've had a couple of managers over time that ended up being thieves.
Oh.
And, the management company wasn't overseeing them. And so there was thievery going on, but then there were also the same people also were not following the proper rental criteria. So they're kind of, rented to people that shouldn't have been on property. And just like any property where you're trying to run it well and have a nice place for people to live, they don't like bad actors as their neighbors. And so, that can get out of hand really quickly. So that has happened to me. And it's not fun, but that's just one of those things you just have to constantly stay on. And it goes back to having a really good partner, in your management company, having a regional manager that, you have metrics that you're tracking on a weekly basis and certain things, are happening. Cause you inspect what you expect, right? So I've always been, I've learned to be a pretty involved asset manager, and I'm sometimes probably even, the property management owner might say that I'm a pain from time to time when I've had to dig into some things. And, I was just like, well, hey, I'm not happy to be doing this, but, if you guys aren't going to do your job, I'm going to make sure you're doing your job, or we're going to make a change. So, none of that was fun, but it's one of those things. As long as you've got some controls in place and you're looking at things on a weekly basis, you can be in tune it and you start asking questions quickly.
Is there a particular control that you recommend to avoid the situation that you had with somebody stealing from you?
Yeah, don't take any money in your office. Number one, make it be all electronic payments. We haven't taken cash forever, but we had some money orders, and that's where the issue came of, just to give you an example, what happened. Pretty crafty, it's like they would rent to somebody that didn't really meet the rental criteria, and so they wanted to charge them a risk fee. And let's say the risk fee was supposed to be, like $200 or whatever it was. They say, well, the risk fee is, $600 and make this money order out to blank, which
Oh, wow.
of course, blank would be the property manager. And, it's just one of those things you wouldn't normally see. So this goes back to a couple of things there. One is, I'm a big fan, especially today, and, going through COVID, a lot of this stuff kind of naturally happened for most people, but, have electronic payment set up and have that be the standard. But then some people are not bankable, and, we understand that. So there's services like Cash Pay where they can go to, Walmart or Albertsons or Tom Thumb, grocery store or whatever, and they can hand the clerk their cash just like they would for a money order, but instead it's an electronic payment to us. So then in the office, there's no changing of any monies. And I would say the same thing about, laundry machines. Don't have coins. If you got coins, they're going to get broken into. Make sure it's all electronic. That solves a lot. And then the second thing in terms of controls is, and this is a tricky thing, frankly, but making sure that, asking your regional manager, are you, how many leases of these leases did you spot check, right? When was the last time that you did it? Or, because the answer is, well, it's been a month or whatever. Like that doesn't work. That doesn't work at all.
So
You gotta have it tight.
So you're saying doing asset management is not only checking the NOI once a month?
I would say done well. No, it is not checking email once a month.
Yeah.
I would definitely say that, at a minimum, you need to have a weekly cadence with, in a minimum, your regional manager. But depending upon the property and the structure, you might also want to have your property manager on there too. And sometimes you want them there, sometimes you don't, because it depends on the kind of conversation you're trying to have. But if you got to circle the wagons, have everybody together on a weekly basis, and I just have a standard agenda. It's a standing meeting. It's half an hour. With them, they know what we're going to talk about. They have a set of reports that they prepare, every Monday morning. They send them to us, and so it's standard, right? And by them filling all of that out, we get a really good idea of where they're at, and then we can ask a few questions. And then, of course, we have kind of, what help do they need, and are there any capital items to discuss. But on the operations side, I think it's really about having a standard weekly process, some standard reports and metrics that everybody knows they have to be filled out, and if they are, it gives you a good pulse of where you're at.
Yeah, makes sense. So we're getting on top of the hour, so I just want to share our dates for our next meetups. So for anyone that's new here, we always meet on the first and third Wednesday of every month. So the third Wednesday, it's going to be our passive investor edition. So that's going to be on June 16. And then we're back on July 7 for the syndication version. And I wanted to share, I know I share Ellen's contact information earlier on, but if anyone wants to take a screenshot, Ellen hopefully it's okay for them to contact you if they
Sure.
want to know
Yep.
more about you?
That's my real email, believe it or not.
And
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.